Welcome to Line of Sight, Clearway Capital Solutions podcast series, where we talk to service providers, stakeholders and industry bodies that can assist fund managers and general partners in building their businesses in Australia and New Zealand. This podcast is for educational and illustrative purposes only and does not constitute and should not be relied upon as financial advice. The podcast will be provided to listeners on the basis that they are wholesale investors only within the meaning of the relevant sections of the Corporations Act.
In this episode, Line of Sight talks with Angelo Aspris, Assistant Professor and Senior Lecturer in Finance at the University of Sydney. Angelo specialises in market microstructure, valuation analysis, financial modelling and big data analysis, amongst other things. Angelo is joined by Mothoneos, Managing Director at Clearway Capital Solutions, where they discuss the future of asset tokenization and its impact on managed investments in Australia.
Angelo, what is tokenization and how might it change managed investments?
So thanks for the question, Dennis. And it's an interesting question and very topical, obviously. As it's sort of come to be understood in recent times, it's just the representation of real-world assets into some programmable digital tokens that's recorded on the blockchain. Now, we shouldn't confuse this term or concept with tokens that are native to the blockchain ecosystem. So many people are familiar with Ethereum, Bitcoin, XRP, and these are native tokens because they are tokens with a claim that is on-chain. And with these native tokens, you can have different categories like utility tokens, governance tokens, security tokens, payments tokens, but essentially they're all tokens with on-chain claims. The other type of token that's generated this recent interest are claims to real-world assets. And by that, we mean sort of traditional assets. So they can be things like equities, bonds, property, real estate, art. It doesn't really matter what it is, as long as it's a market with some kind of unit economics, then you can tokenize this type of asset. So what you're doing very simply for this non-native category, in a very generic sense, obviously, is you're applying a legal wrapper over the traditional asset. And what that does is it creates a digital token within the blockchain ecosystem. So you're essentially creating an investment environment where you have sort of digital native and digital non-native assets, and they can cohabitat in this, which is obviously quite useful for the managed investment space because you've got a broader scope of investments. Going directly to the question, why is it important and how might it change things for managed investments? Well, I think firstly, the benefit here is that it can improve accessibility to assets. So if you've got assets that previously operated in opaque environments with opaque structures, by having this sort of on-chain and off-chain asset platform that pairs these assets together, you can increase that accessibility. Secondly, what we might see from tokenization is a change in processes which managed investments operate. And so the way that you communicate with your unit holders and the way in which the operations are managed can become more efficient. And so if we incorporate, let's say, smart contracts, for example, we can sort of streamline a lot of the labor-intensive processes. And you can also improve transparency of those processes. So you can imagine things like capital calls, for example, or income distributions. They are, by incorporating within the smart contract, you're creating a much more efficient process. I think beyond that, and probably one of the bigger benefits here is around that settlement process. And in this environment, you basically, you simultaneously settle with payment. So we again remove another source of friction, or if you want, you can sort of flip this on its head and sort of say that you're improving capital efficiency by having those funds that are tied up in transit for a shorter period of time. So those efficiencies are improved by the fact that within this environment, you can have smart contracts that also work for a different class of investors. So again, rather than sort of with the underlying asset, you find with some assets that you're transacting in quite large lot sizes. So when you're dealing with smart contracts and you're dealing with tokenized assets, assets that may have been prohibitive to, let's say, a group of retail investors, you can now have an environment where you're fractionalizing those assets, which means that these investor groups that couldn't transact in these large lots now have the ability to do so. And so that, from a portfolio perspective, can create a much more efficient portfolio. And I think then, just finally, I think if you sort of tie in also the benefits that are associated with having a clear audit trail, the fact that the blockchain is immutable, and then you can ascertain asset provenance at any point. When you've got more complex order flows, as we tend to generate through time, that clarity and that transparency is something that is quite useful and quite beneficial to the managed investment process.
What are the key legal and regulatory issues regarding tokenized investment products?
So I think this is a really important and complex issue because you're dealing with basically the rights, obligations of users, investors, and those obviously that are facilitating that process. And so key here is just the economic right of that underlying asset, and that's represented by the digital token. And then you've got to think about the governance that's associated with that management process. And the thing about this is that you're also introducing risks to the process that are not part of the underlying process. So the underlying asset obviously has its own inherent risks, but we're introducing sort of a risk layer on top of that when you tokenize the asset. So, how you deal with wallets, seed keys and smart contracts, and how you deal with public and private addresses just introduces this new layer of technology risk. So those, therefore, that have the responsibility of managing the portfolios have to deal with this sort of new class of foreign risks. So I think to a certain extent, those risks, they can be managed within the current scope of our rules and regulations, whether it's the Corporations Act, the AFSL, that they can sort of be managed within the scope of regulations and rules that we have. But if we take a leaf out of, let's say, what is happening in Europe and in the US, we will have to eventually develop a separate framework that deals with crypto assets. So that is, I think, a direction that we're going to have to go in. And that issue goes to the issue of if you've got managed investments and you're dealing with investments across different jurisdictions, you want a sort of harmonious environment to be able to operate in. You don't want one where you've got this sort of regulatory arbitrage going on, because that isn't something that is beneficial, obviously, to the participants in this market.
How could licensing regimes, and you sort of already touched on this, but specifically in Australia, how could the licensing regime evolve to accommodate tokenized funds and distribution of those funds?
Yeah, so like you say, we already have, I think, a bit of a framework in place to be able to do that. And so it's the same, I believe, obviously, anywhere in the world where you go, that has some kind of Corporations Act in place and some kind of licensing arrangement for the different participants in that marketplace. I think, it's a nice, if we take something like, BlackRock, for example, they launched a tokenized money market fund back in 2024. And that deals with programmable assets and provides direct dividend distributions to their unit holders. And the reason I think that's kind of important is it's been around since 2024, and it shows us there is already the groundwork there to have funds that are important and are growing in size. So I think the AUM for BlackRock's programmable asset money market fund is about $2 to $3 billion at the moment. So you can see that there's a lot of interest in that. And I think one of the advantages, or the way that BlackRock has approached this, is that they recognise that firstly there's the demand for such a fund, but they've also recognised that in order to do this, they need to partner with experts in the area. And so this is a partnership between them and Securitize, who essentially are the ones applying the legal wrappers to these funds. The investments are short-term investments in treasuries and repos, and everything is programmable, and everything is also part of a smart contract. And so the point here is that in this case, that's all regulated up by the SEC. We similarly have a legal framework where we could do something. If you wanted to launch a tokenized fund in Australia, you could do so. It would become more complex, and there are more issues that would arise if you're dealing with, let's say, assets from a more opaque space in terms of their pricing is more opaque. The reason why something like this works really well is that you have daily distributions, and you also have very liquid market with very liquid pricing. So in terms of how it would evolve, if we change, let's say, our focus from instos to retail, and if we considered a broader, let's say, subset of investments, and we're trying to bridge the traditional space with the digital asset space, then we would probably need to think about things like regulatory sandboxes, and sort of experimental-like settings where we try and balance that sort of efficiency versus integrity trade-off. And if we do that, obviously, we can find an ultimate balance that is acceptable. But those are the kind of discussions that would have to be generated, or at least initiated by the regulators themselves.
How is Australia placed in regards to other jurisdictions like the EU or the SEC in regards to licensing of tokenized funds and assets?
Yeah, so I think to a certain extent, Australia is playing the wait and see game. There was a while where digital assets were not the flavour of the month, and the regulators kind of sort of almost dropped all those conversations. Those live conversations almost fell to the background. The fact that with the adoption of the Genius Act in the US, MiCA in Europe, and other jurisdictions in our Asia Pacific region like Singapore, moving forward with digital assets and embracing digital assets, I think what you will see now is an acceleration. Clearly, there is a demand for holding digital assets, and so the managed investment community are kind of hammering the door, saying, give us some guidance, give us some rules by which to operate, so that we can meet that demand.
Angelo, what sort of cost efficiencies could tokenization deliver in funds management?
Yeah, so I think I've partly addressed this issue, and you can probably summarize this question, I think, by saying that there are two classes of efficiencies. The first one arises from direct costs of management, and so in this category you would have compliance checks, third-party administration. They're all sort of things, because you can build them into the smart contract and you don't need that manual oversight. You're sort of cutting those costs out of the equation. But to me, the bigger efficiencies lie in the capital efficiency gains, and that simply evolves from the fact that the money is tied up into settlement for a shorter period of time. And so what that means is the money's working for you. So instead of having T+1, T+3 settlement, you've got instantaneous settlement. And so that money doesn't sit in transit. That money can be used to generate additional income. And so it's that capital efficiency for me that is the real value add. There's some research out there that's from JP Morgan, for example, that suggests that you've got about you can improve cost efficiencies in the order of around 20% through changing the framework in which you operate. The Digital Finance CRC, which is based in Australia, estimates those costs in the order of about $12 billion annually. So they're quite significant efficiencies, which means that we should really be exploring this change and embracing it with more gusto than perhaps we have in the past.
You've already touched on this, but maybe if you could drill a little bit more on what kind of new risks would be introduced by tokenized investment distribution.
Yeah, so thanks for the question, Dennis. I think we could probably house this under several different banners. The first being associated with an environment that isn't well regulated to protect clients. And although I've mentioned already that the current regulations do a reasonable job, to protect investors, the fact is that the technology is evolving pretty rapidly, and so if the technology continues to evolve rapidly, we get different standards, for example, of tokenization in the sort of digital asset class starts to encompass, a different set of assets with opaque pricing and opaque demand and supply schedules. Then you get into a sort of an area that becomes a little bit more uncomfortable. And so the point there being that if we sort of move away from these traditional assets and we move into an area where, let's say there are multiple chains that now start to evolve and you've got interoperability issues, you need more specific, more nuanced regulation. And so the risks will always be great when the technology is evolving so quickly. And so the frameworks therefore need to be a lot clearer. I think a second source of risk is the operational risk, and that stems from the fact that if you're not adequately prepared, if you don't understand the risks of the environment in which you're operating in, so for example, an inability to have systems that are technological aware, or if you haven't dealt with sort of vulnerabilities associated with hacking, or if you haven't got a trained workforce that doesn't understand the nuances of smart contracts and smart contract risks, then you're potentially making yourself and your clients vulnerable to these technological risks. And so these are something that are quite important in the tokenized investment space. The final category for me stems from the tokenized investments themselves, which, as we noted, they're just representations of the underlying assets. And so one of I think the things that we overlook when we talk about these tokenized assets is that you could potentially end up in a situation where you have a sort of liquidity mismatch between the underlying and the tokenized asset. And if you do have this sort of liquidity differential that emerges, or a mismatch rather, that emerges between the tokenized asset and the underlying asset, then that might present itself in terms of asset pricing frictions or issues. And so if you compound that then with the fact that, let's say, you might run into some redemption issues, then the liquidity mismatch with the redemption issue then can potentially result in sort of widespread systematic risk. And so for me, that's probably the most significant risk that we run into. And that is a risk when, maybe not necessarily with the BlackRock short-term treasury framework that's been established, but when you're dealing with, let's say, real estate assets, you can very much end up in a situation where you have this opaque, not very liquid market off-chain, but on-chain ends up being quite liquid, and then you have all sorts of issues that emerge. So Dennis, I've got a question for you. How will the role of managed fund business development managers, so BDMs, and distributors change?
Thanks, Angelo. That's an interesting question. If tokenization is adopted, as we believe, over time, it's very likely to transform traditional business development in funds management. In the past, BDMs primarily focused on building relationships with gatekeepers, including consultants, advisors, platforms, and institutional investors, and communicating a fund's investment strategy and value proposition. However, as tokenized investment products become more common, the job will require a much more deeper understanding of technology. Business development managers and distributors more broadly will need to confidently explain not just what the fund invests in, but how tokenization works. And that would include the basics of smart contracts, distributed ledgers, and settlement in a digital context. This shift also means that distribution will move closer to the end investor instead of relying solely on intermediaries or partially on intermediaries. Tokenization allows for more direct-to-investor engagement through digital marketplaces. Consequently, business development managers and distributors will need to be adept at communicating the benefits of tokenization, like fractional ownership, enhanced liquidity, faster settlement, and automated compliance in a way that builds trust with clients. In essence, modern business development managers will evolve from relationship-focused salespeople to more digitally fluent, strategic advisors, relationship managers who can bridge finance, technology, regulation, while helping clients navigate a changing investment landscape.
Yeah, that's great, Dennis. And just to sort of touch on this a little, let's go into this a little further. So do you think distributors and BDMs will need new skills? Do you think there's going to be the need for further upskilling?
Yes, of course. Tokenization introduces a whole new layer of complexity that demands a hybrid skill set, part finance, part technology, potentially part compliance. Our white paper that we co-wrote with you outlines several key capabilities that distributors will need to develop to stay effective and relevant. One of them is digital and technical literacy, which we kind of touched on, understanding how blockchain networks operate, how smart contracts are created and executed, and digital custody and wallets and how they work. They'll probably need to develop different sort of compliance understanding in a digital context that will probably be quite important. Also, they'll need to further develop proficiency in data analytics. Tokenized platforms generate a lot of investor data than ever before, and it will be helpful for them to be able to interpret this data to create personalized marketing strategies. And also, they'll probably have to have greater global awareness. Tokenized investments can be accessed cross-border, or will likely be. Business development managers wanting to understand how different jurisdictions handle eligibility, disclosures, and onboarding requirements. Overall, the next generation of business development managers will need to blend relationship management with tech fluency. They'll act as translators between product engineers, compliance teams, and investors, making complex digital concepts feel accessible.
The selling and client service process changing?
Yeah, I think it's going to change significantly. It's going to take time, but I think there's going to be a shift towards direct-to-investor channels, where clients or investors access tokenized products via digital marketplaces and wallets, bypassing traditional finance intermediaries. Investors will probably expect 24/7 access to trading, reporting and servicing. So that will be, I think, a bit of a change in how we think about servicing investors in comparison to traditional finance. And smart contracts will automate some of the servicing elements around dividends, redemptions, corporate actions. And I think, once distributors and business development managers educate themselves on how smart contracts could improve that servicing, then that will free them up to develop higher value discussions with investors, that they won't get necessarily bogged down in some of these more administrative related elements of their job.
That's great. Thank you for that. So I'm just going to take you down a slightly different direction here. Could you tell us a little bit about Project Acacia, what the implications of it are, and what specifically they are for the distributors?
Project Acacia is a collaboration between the Reserve Bank of Australia and the DFCRC, which we discussed a little bit earlier. And they're in the process of testing the use of digital money such as CBDCs, deposit tokens, stablecoins in tokenized markets. Currently, it's in its second phase, which includes 24 use cases with banks, fintechs, the regulators, and other participants. And I think, where for distributors, it could open up opportunities for new financial products such as tokenized bonds, carbon credits, and private equity instruments, all settled in digital money. So I think that's something that they're trying to work on. And as we discussed before, will probably facilitate faster and cheaper and reliable settlement, which will help to become a strong selling point for distributors.
Okay, so I've got one more question for you. In terms of compliance, so how should practitioners address the AML CTF obligations in tokenized distribution?
Yeah, that's a good question, Angelo. AML and CTF obligations will remain unchanged. However, just adapting that compliance system to a tokenized environment will be interesting. As we sort of mentioned before, programmable compliance could embed KYC and AML checks into the token transfer code, potentially blocking transfers to unverified wallets. And DeFi models, I should mention, DeFi models might complicate that accountability since there's no central operator that exists to enforce those checks. So this raises the question of who is responsible for that suspicious activity. Policymakers are also exploring whether to create a new responsible entity category for tokenized products to ensure accountability even in a decentralized environment. But yeah, it's an interesting area. As I said, the obligations won't change, but the adaptation of those systems to a tokenized environment will have to change to some extent. Angelo, one last question for you. What role will CBDCs and stablecoins play in tokenized fund distribution?
Yeah, so thanks for that. And I'll just sort of piggyback off your earlier response here. And I think you can go obviously a number of different ways with a question like this. To me, stablecoins represent the rails for these tokenized funds. So when we're talking about, let's say, settlement, for example, and the fact that you can have the promise of instantaneous settlement around the clock, then that's only possible because you have stablecoins. So you can think of stablecoins here as the infrastructure that not only sort of lets you in to the digital asset ecosystem, but it also grants you those kinds of benefits around instantaneous settlement and this immutable audit chain. Now your question goes sort of a step further here because it implicitly sort of asks whether or not, let's say, decentralized stablecoins or centralized stablecoins being your CBDCs, which are tied to your central banks, whether it be the RBA or elsewhere, whether they're going to play a bigger role in this space. And sort of to get to the bottom of a question like that, you'd need to sort of have a view on the sort of the significance of the counterparty risk. So, is the stablecoin, for example, sufficiently collateralized to the issued tokens versus the efficiency of the two systems? And the issues around efficiency might be with respect to the fact that your operations might span multiple jurisdictions. So if you've got a CBDC, that is kind of uncertain, whereas we know with this decentralized stablecoins, that's more proven. And so in addition to all of that, you've obviously got privacy issues and how clients will perceive those privacy issues when you've got decentralized versus centralized stablecoins. In my personal opinion, I think as long as you've got a well-regulated sort of decentralized stablecoin system, then you can somewhat forego the CBD solution, the CBDC, whether it's a wholesale or retail solution. It's not that it's redundant, but you've already got a market solution. And so I think that for that reason, it will remain the preferred solution. So to come back sort of full circle here to your question, I think stablecoins obviously play an important role in tokenized funds, and will probably have some complement of decentralized and centralized stablecoins as being sort of the rails in this system.
Thanks, Angelo.
Thank you.